Hi everybody, today I'm going to provide an update on my stocks and unit trust performance for the year 2022. And I also want to share on the 10 Singapore stocks that is currently in the portfolio. Now let's look at my stock portfolio as 31st of December 2022. Currently, there are 10 Singapore stocks and 10 US stocks, and the stocks investment have down about 7.8%, where I still got about 37% of cash. The total amount invested into this portfolio is 50,000. Since my last update on 22nd October, I have actually averaged in Parkway Life, Disney, and Costco. But I also have trimmed the Visa positions to take some profit off the table. Currently, of this 20 counter, 8 Singapore stocks are in the red and 2 Singapore stocks are in profit, which happen to be OCBC Bank and CapitalLand Invest. And for the US stocks that are in profit is Johnson & Johnson and Visa. The total dividend I collected for the whole full year is 340 Sing dollars, and I will expect the dividend will be very much higher for 2023, as this portfolio just started from 1st of January 2022. For 2023, I will still continue to top up this portfolio 1 month twice, and hopefully by end of 2023, I can make portfolio that have invested 100,000. As of end 2022, the portfolio have made a loss, including dividends added in $2,524, which translates to about 5.05% losses. Let's look at the performance of my stocks against the index. So let's look at the Singapore stocks against STI index. Of the 6 Singapore stocks that is in my portfolio, only 2 of them have beat the STI or outperformed the STI, CapitalLand Invest and OCBC. We have noticed that STI actually for the year 2022 have achieved a positive returns, but compared to the global major market like Hong Kong market, China and US market, which have recording double-digit losses. The other 4 stocks underperformed the STI, and sets have dropped 27%, mainly due to their upcoming right issues. We'll talk about that later. And what about the REITs? All the 4 REITs in my portfolio have underperformed STI. As we know that currently it's an interest rate rising environment, almost all the REITs have underperformed the STI, including the REITs ETF and REITs index have underperformed the STI. The one that performed the worst against STI among my 4 REITs are Parkway Life. Okay, what about my US counter? There are 6 stocks listed on the New York Stock Exchange, so I'll compare with S&P 500. Of the 6 US stocks that are listed in NASDAQ, 4 of them have outperformed S&P 500, and Johnson & Johnson have even delivered a positive year-to-date returns of 5.21%. Nike and Disney have underperformed the S&P 500, and Disney have underperformed the S&P 500 by a big margin. What about the other 4 stocks that is listed on NASDAQ? So I also want to compare with S&P 500 and also add in the NASDAQ Composite Index. All 4 of them have double-digit losses for the whole year of 2022, with Costco slightly better than S&P 500, while Apple, Microsoft, and Google underperformed the S&P 500. And Google even also underperformed the NASDAQ index. I'll continue to stay invested in this 20 counter currently, and if I were to invest in another counter, I will most probably will need to sell off one of the stocks. As at this juncture, I have no intention to increase the number of holding to be more than 20 until the later stage. Let's look at my unit trust portfolio. The capital investor is 36,200, and for unit trust portfolio, it is a fully invested portfolio. That means there is no cash reserve, unlike the stocks portfolio where I currently have 37% cash sitting at the sideline. And this actually have increased the volatility of this unit trust portfolio, as all the 6 funds I invested in are all equity funds and all are high-risk funds. And as of end December, there is none of the funds have give positive returns, which their performance are in line in the overall broad market. And I have do money top up and regular investment for this unit trust I doing this year. Thus, you can see that the portfolio losses is less than 10%. However, you to analyze it, the year-to-date return for this portfolio actually is negative 16.56%. For the unit trust portfolio, I'll make some changes for 2023. Instead of having a heavy RSP and a smaller amount of lump sum top up, I want to smoothen it and make the investment of this on a weekly basis more even, as there's no transaction cost incurred for me to invest in this unit trust compared to the stocks where there's brokerage commission I need to pay. Thus, I can invest the unit trust on a weekly basis on a smaller amount, and this will make the DCA, instead of monthly DCA, will become more like a weekly DCA. This should be able to help to cushion the volatility of the portfolio, and hope that long term it can enhance the portfolio returns. So now let's look at the 10 Singapore stocks that is in my holdings. For those that want to know more about the 10 US stocks that in my holding, you can refer to my previous video where I talk about the 10 US stocks. I arranged the Singapore stocks in alphabetical orders. So the first stocks I'm going to talk about is called CapitalLand Ascendas REITs. It's the second largest REITs listed in Singapore, but on the industrial REIT sector, it is the number one. And you also have the most number of property among all the REITs in Singapore, where it currently have 228 properties and with an asset under management of approximately 16 billion. This REIT currently have a market cap of 11.5 billion and with a trailing 12-month dividend yield about 5.65%. And the current price to book ratio is 1.15, which is trading at a premium. However, do take note that this REIT is constantly trading at a premium, regardless of market conditions. This is a Singapore-focused REIT with assets across developed markets. More than 50% of their asset will be based in Singapore, and they will have asset in the developed market like Australia, US, Europe, and UK. It is a multi-asset portfolio among the industrial REIT sector, which actually have encompassed almost all the various asset class industrial REITs would have, which include business space, logistics, data center, industrial, and even have a life science property, where currently I think none other REITs in Singapore have that. Ascendas REITs is one of the first REITs that IPO in Singapore, which is currently on the 20th year. And over the past 20 years, its balance sheet is constantly remain very healthy, and its aggregate leverage is constantly remain in a very healthy range, just like the latest one, which is at 37.3%, which to me is a very healthy and pretty optimum aggregate leverage for a REIT. The interest cover ratios, although have come down, if you based on quarter-to-quarter basis comparison, okay, however, it's still way above the MS requirement of 2.5 times. And the all-in cost of debt have clipped up slightly from 2.1 to 2.2. This one, it can't be helped because of current rising interest environment. But one good thing is the fixed rate component is 78%, which is on the high side, which is good for an interest rate rising environment. When we look at REITs, we want to look at the REITs that their dividend have been growing year on year. However, it is very tough for REITs to achieve positive dividend growth every year, regardless of market conditions. And Ascendas REITs have actually suffered a drop in dividend due to the global financial crisis, and also a drop in dividend during the COVID pandemic period. But the next part is we want to see that can they actually recover back after that. And from here, we can see that actually their dividend have recovered back after the global financial crisis, and now they are on a recovery path from the COVID situations. And do take note that for this, is not really a big dip in the dividend, as they have changed their financial year reporting from end at 31st of March, changed to end 31st December, which explains why FY 2019 their dividend DPU is so low, as it's only comprised of only 3 quarters of dividend instead of normal 4 quarters. Let's look at the price performance of this REIT against STI. This is a total return performance at Ascendas REIT, which include their dividends, and actually still underperform the STI. And in fact, if we add the dividend, it's still giving negative return for 1 full year. Nevertheless, the drop of minus 2.32% is quite minimum when it compared to the REITs index, we have dropped double digit. When I invest, we are looking for a longer term period. And let's look at the 5-year chart. Ascendas actually have outperformed the STI by a big margin. Our 5-year total return is 34%, compared to STI is negative 4.45%. The second stocks that in my holding is called CapitalLand Invest. Is a sponsor for CapitalLand Ascenders. CapitalLand Invest have transformed himself or have spin out of his property development business. It now is moving towards real estate investment management company. It's in a process of transforming, and this is a target for fund under management is 100 billion for 2024, and their lodging in it is 160,000 keys, and annual recycling target is 3 billion. And let's look at some of the data. The current market cap is about 18 billions. The price to book currently is 1.23, which to me is very low when compared to those global REIM companies. And their dividend yield is 3.24%. So this is their three main business. One is the fund management, where currently they have fund under management is 86 billion, which is about 14% shortfall from their 2024 target. And the number of keys they have now is 155,000 keys, which is very near to their targets for 2023. And for the past 9 months, they have recycled 2.4 billion, which is very close to their yearly target of 3 billion. One thing to take note for the FUM for CapitalLand Invest is they are very Singapore and China focused. Singapore and China itself contribute more than 70% of their FUM, and the rest will come from India and other Asia portion. And for the non-Asia market, which actually is contributing less than 10%. So it will still be a long way if CapitalLand will want to grow really globally, but it can be also an opportunity for investor. And their lodging business, where currently they got more than 150,000 keys, which also highly concentrated in Asia, where you can see that the Southeast Asia and North Asia contribute the main bulk of their lodging business, where Europe, Middle East, and America are contributing around 20%, which means actually there is a lot of growth potential for CapitalLand to expand globally also. CapitalLand Invest have announced a 12-cent dividends, which is the same dividend payout before the COVID period and under the old CapitalLand umbrella. And on top of that, they also give out special dividends in a format to top up the dividend drop during the COVID period, which is 9 cents. So to make it up for the lost dividend. This is something that a lot of companies do not practice that, which I found that it is really a goodwill gesture done by CapitalLand Invest. Let's look at the performance of this. It have actually outperformed the STI for the year of 2022. However, it do not have a long history. CapitalLand Invest was officially formed in around Q4 of 2021, and actually it made a return of 30% from Q4 2021 to today. The third company I'm going to talk about is called ComfortDelGro, which is one of the largest land transport company in the world, where they have close to operating fee of 15,000. And ComfortDelGro have a market cap of 2.66 billion, and the price to book is 0.96. The P ratio is 16.9. Closing dividend yield is 4%. ComfortDelGro is not only on Singapore per se. However, Singapore is still remain their main focus, where more than 50% of the revenue actually you can see is generated from Singapore, followed by another two big market. Under them is UK, Ireland, and Australia. However, come down to the profit side, Singapore market is the major contributor for their profit, followed by Australia. And in fact, their UK and Ireland have been suffering losses due to the pandemic and due to the current market conditions. There's a misconception of ComfortDelGro that a lot of people always talk that as a taxi company. In fact, that its main revenue is come from the public transport, which is the bus and the rail. In Singapore, we call the MRT, where from here you can see the breakdown of the public transport, which contribute the main bulk of their revenues. Also, same thing, it contributes the main bulk of their profits, where the taxi business contribute about slightly less than 20% of their revenue and their profits. With the global start to reopen, ComfortDelGro is supposed to be a recovery play counter. However, due to certain external factors like the drop in pound currency, where they are now suffering losses, and also drop in Aussie dollar against Sing dollars and the US dollars, plus they are being kicked out from the STI index. This caused certain uncertainty in the company, and which is why caused their share price quite depressing at this juncture. But nevertheless, ComfortDelGro still have a dividend paying policy that they will continue to maintain they will pay out at least 50% of their PATMI as dividends. And let's look at their dividend history before the COVID level. In fact, they are increasing dividend paying company with the dividend payout ratios on average around 70%. But due to the COVID, their services are being directly hit, which caused them to have a big drop in their dividend. But as long as their PATMI is not negative, they will still continue to pay dividends, which so that at FY 2020, they're still able to manage to pay out a little bit of dividend. And now they are on a recovery path. And for FY22, we can see that this is exclude the special dividend. This is a half-year dividend where actually they should be on a recovery path for the dividend payout if the business continue to improve further. And let's look at the price chart performance. For 2022, they have underperformed the STI by more than 10%. But when you look at the 5-year price chart, actually they have also underperformed STI and actually they have dropped 22%. And they have a very big plunge in their share price due to the COVID pandemic. But however, they have yet to recover. And in fact, now their price are even lower than the pre-COVID price. And now their current trading price is around or even lower than their COVID period trading price. The next company is a REIT, is Mapletree Logistic Trust, which have a market cap of 7.6 billion and with the dividend yield, trading dividend yield of 5.64%. and price to book of 1.09. This is a REIT that is also constantly trading at a premium regardless of market conditions. And this REIT currently have 186 properties, which make them to be number 2 in terms of quantity of property they have among all the Singapore REITs. Their property is scattered around the Asia Pacific region and including Australia, and also they got 2 property in India. One thing to take note of this REIT is this is not a Singapore-focused REIT, as Singapore contribute only about 1/4 to their revenues. The rest will be mainly from Hong Kong and China, which contribute more than 30% of the revenue, followed by the rest of the Asia-Pacific region. The current balance sheet of this REIT is pretty healthy with a gearing of 37%. The same fate happened to this REIT is that we can see that their interest cover ratios actually have dropped due to increasing borrowing costs. And nevertheless, it is still within a healthy range of more than 2.5 times. And this REIT have been IPO since 2005. We have been close to 17 years in the market, and it have a very great track record since 2005, where they deliver a total return of more than 300% as of 31st of March 2022. Their dividend is on the increasing trend since IPO until today. And despite the COVID period, their dividend continue to increase. Let's look at the price performance of this REIT. They have also underperformed the STI, and they have down about 11.5% for the whole year of 2022. But we will to put it over a longer time perspective, over a 5-year perspective, actually have outperformed the STI by a big margin. The next counter is also a REIT. It also belongs to the Mapletree family. It is called Mapletree Pan Asia Commercial Trust. It is the 3rd largest REIT in terms of market cap among all the 30 over REITs, and its market cap is 8.7 billion, and its current dividend yield is 5.71%, and it is trading at a slight discount of 0.96. This REIT is formed by the merger between MCT and MMACT, where a Singapore-focused REIT merged with a North Asia-focused REIT. And currently, they have 18 properties scattered around Tokyo, Korea, China, Hong Kong, and Singapore. But do take note that Singapore is still the main contributor for the REIT revenue, where VivoCity and Mapletree Business City contribute 41% of the portfolio, but Festival Walk contribute also about 1/4 of it. So actually, this REIT is mainly formed by these 3 major properties, where the rest of the 15 properties make up the balance of the contributions. Let's look at their financial metrics. Their gearing ratio is 40.1%. It's still in a healthy range, but with this gearing ratio, it is pretty tough for the REITs to do acquisition via equity fundraising. So this is something that we will need to monitor, that what are they going to do with this gearing ratio, and what are they going to do with some of their properties. And their interest cover ratio have come down, but it's still also very healthy range of the 4.4%, and the fixed rate is still above 70%. As I have mentioned, that during an interest rate rising environment, I would prefer REITs that have more on a fixed rate basis rather than on a floating rate basis. This is a track record of the two REITs where Mapletree Commercial Trust in fact is one of the top 3 best performing REITs in Singapore that have more than 10 years track record, and their DPU have a CAGR of more than 5.4%. But let's look at Mapletree North Asia Commercial Trust, where their DPU CAGR over 8 years is only 1.7%. It is still a growth, but compared to Mapletree Commercial Trust, it is relatively lower. But we also need to take into consideration that they have suffered during the Hong Kong incident and also during the COVID period, which explains why they have a low growth in DPU. But after this merger, I hope that they will have more synergy and quite positive on their future growth prospect, which is why I invested in this counter. Let's look at the price performance. They have underperformed the STI and over 5-year period, but over the 5-year period, they have actually in fact outperformed the STI by a margin also. The next counter is the bank stocks. OCBC is one of the 3 banks, major banks listed in Singapore. They have a market cap of 54 billion and a price to book of 1.0 and with a dividend yield of 4.6%. OCBC is not a bank that just purely rely on interest margin. You will also have another source of income from the wealth management and the insurance sales side and other form of fee income, and to compensate for it. And actually, I prefer a bank that have 2 main sources of income that are growing rather than rely on one source. And OCBC have grown over the years. Wholesale banking will still be the main part for contribute about 46% of their profit, followed by their private banking and also treasury and market business. Insurance business contribute about 18% and followed by others. And they are not only located in Singapore, but Singapore will still remain their main focus, where it contributes 49% of their profit, followed by Greater China, Malaysia, and then Indonesia and others. They have a very good dividend paying records, and their payout ratio is one of the lower among the 3 banks in Singapore. There is a dip in their dividend payout in 2020. The dip is because there is a cap imposed by MAS for the bank to be more prudent in paying out their dividend during the COVID period, and it's not that they are not able to pay. So after the cap is be removed, they restore back their dividend. And in fact, for the first half of 2022, they have actually paid higher dividend compared to the 2021. It had outperformed the STI by a margin, and with the whole OCBC over 5-year period, actually it also have outperformed STI. The next stock is Parkway Life REITs, which is supposed to be a defensive REIT. Parkway Life REITs is the largest listed healthcare REIT in Asia. It has 55 properties with 3 properties in Singapore, 51 in Japan, and 1 medical center in Malaysia. The portfolio size is 2.29 billion, and close to 60% of its revenue is generated from the 3 hospitals in Singapore, where the balance 40% of revenue is generated by the 51 properties in Japan. It have a market cap of 2.2 billion, and the dividend yield is 3.74%, and its price to book is 1.56. Parkway Life REITs have been constantly trading at a very high premium, and usually the price to book is above 2. However, lately it suffered a big drop because its price to book dropped to 1.56, which is among one of its lowest in recent time. It have quite a good gearing of 34.9%. However, due to the size of the REIT, it is less than 3 billion. This headroom is only good enough for him to do acquisition on nursing home, but not hospital, as hospital will require a bigger headroom, and thus if they were to acquire hospital, some form of equity fundraising may be required. And Parkway Life have a very impressive DPU growth track record. In fact, it's one of the best among all the REITs, and the DPU have been growing across the global financial crisis at 2008, and it also grew during this COVID pandemic period. Since IPO, the DPU have delivered more than 118% returns, which indirectly means that the capital invested during the IPO period is already being cashed out as dividends. Let's look at the stock chart for Parkway Life. Its performance is the worst among the 4 REITs that I have in the portfolio, and it have dropped 25% for this year, mainly due to this current interest rate rising environment, and this REIT have low dividend yield, plus 40% of the revenue is generated from Japan, and people are concerned of Japan currency drop against US dollar, which indirectly also against Sing dollars. But we're looking at a 5-year period, it is still able to deliver 55% positive return, which have actually beat the STI by a big margin. The next stock is SATS, which is mainly providing food and getaway services, where they call themselves Feed and Connect Communities. And the market cap for SATS is about close to 3.2 billion, and SATS have not been paying dividends since the pandemic started, as they are not making any profit. They are actually being hit badly by the pandemic, as we know that traveling have freeze, airport have no passengers. So this have badly affected their bottom lines. Their revenue are pretty well spread out, where 50% from the food solution and 50% is from the gateway services. However, they are very skewed towards travel, where you can see 72.5% of the revenue is from travel related. And Singapore is still the major contributor to SATS, contribute close to 80% of the SATS revenues. Their financial metrics have been improving since the pandemic. One thing good about SATS is that their net cash position is still positive, despite that they have been losing money during the pandemic period. Now they are facing higher costs due to high inflation rate, higher expenses when the economy starts to reopen. Before the pandemic start, SATS actually is a dividend growing stock. You can see that the dividend is growing year on year until the pandemic strike, where they have a drastic cut in their dividend, and for the 2 financial years, they have not been paying dividends. They will only start to resume paying dividends when they become profitable again. SATS was also in the news recently, not in a positive way, which caused their share price to plunge more than 20% in one day, is that they have announced that they're going to acquire Worldwide Flight Services, WFS in short. But however, SATS currently their financial strength is not so strong due to the pandemic, and they want to acquire this company through a form of right issues. And investors don't write right issues for stocks, and this create a sharp decline in the share price. They will have an EGM to share with investors about this matter in more details. And what is WFS? Actually, WFS is a global aviation services company that mainly focus on cargo handling. They are mainly active on the major European and US airport, while SATS is mainly operating in the Asia side. So by acquiring WFS, SATS will become the major player of cargo handling in the world. So from this, it looks like by acquiring WFS is a good thing for SATS growth futures. However, because of their current financial status and because of they need to acquire right issues, this caused their share price to plunge. They come up with a proposed funding idea where they will pay $1.8 billion to buy WFS, and 800 million will become from the right issues. As for the right issue price and how much price every shareholder will be entitled, we will only know more after the EGM is over. Let's look at the price chart performance of SATS. We can see that there is a big gap down of SATS after they announced they're going to acquire WFS by right issues, and it have trend down further until currently the price have been stabilized. And I believe that SATS price will currently still remain weak in the near term until there's more certainty on that. Let's look at their 5-year track record. SATS actually in general have performed in line with STI over the past 5 years, except that during the pandemic where they actually have dropped drastically, but they managed to recover back, and they have hit a new low after the announcement of the acquisitions by right issues. I'll make a decision on what to do with SATS after there's more clarity on the outcome of EGM and more details on the right issues. The second last counter is SGX, which is Singapore Exchange, which have a market cap of 9.5 billion and a dividend yield of 3.58%, and the PE ratio is 21.19. SGX have evolved and transformed over the years since their IPOs many years ago, and now they have mainly a few segments of business. One segment is we call it FICC, which is the fixed income, currency, and commodities. The second one is called the equity business, which comprises of equity derivative or equity cash. Okay, equity cash is mainly on the trading side of the shares directly. And next, they got the data connectivity and the indices. So these are the 3 core revenues for SGX. And they got another additional revenue called the treasury income. This is what SGX have been transforming over the years. Their market is mainly focusing on the Asia Pacific region, okay, where the forex they are very strong in US dollar against renminbi and India currency against US dollars. Commodity side, they got big trading volume in iron ore and other commodities. They have been expanding their arm to have global partnerships so that they can broaden their products and distribution footprint. So gone will be the day that SGX is just purely depending on Singapore stock market tradings. For SGX, their balance sheet is very healthy, despite their debt have been increasing slowly over the years, but it is still on a very, very low side. And they take on debt is mainly to acquire company for them to grow. SGX have a very impressive dividend track record, and in fact, I consider SGX as a dividend growth company. We take the outlier of global financial crisis out, and from here we can see that actually their dividend have been increasing on an ongoing basis, and they are one of the few companies listed on SGX that pay dividend 4 times a year. And let's look at the chart performance. SGX have underperformed the STI by a small margin for 2022, but we look at a longer time horizon for 5 years, actually he have outperformed the STI by a big margin. The last one I'm going to talk about is called ST Engineering, which is a global technology, defense, and engineering group with businesses across the aerospace, smart city, defense, and public security segment. ST Engineering have a market cap of 10 billions with a PE of 18.83 and a dividend yield of 5.37%. Its revenue mainly generated from 3 sides. One is called the defense and public securities, and now one is the commercial aerospace, and followed by the urban solution and StatComs. From this table, you can see that defense will still be the major contributor, will contribute more than 50%. And Asia is the major market that contribute to the SET's bottom line, followed by US and Europe. One thing I like is they have a very robust order book, and as of 30th of September, their order book already have 25 billions. With a strong and growing order book, this shows that the company is still growing in terms of revenues, and also it also creates certainty to the company on their revenue side. However, SETs have been paying stable dividend for years, which is 15 cents every year, and this dividend don't grow. And the payout ratio is close to 90% on a year-on-year basis. The good news is at February 2022, ST Engineering had decided to declare dividend every quarter instead of twice a year. And furthermore, they have decided to increase their dividends from 15 cents a year to 16 cents, and they'll pay 4 cents every time. It is joining one of the few companies that is paying dividend 4 times a year. Let's look at the chart of ST Engineering. In fact, it have outperformed the STI until September, where there is a market correction and assets have started to plunge further down and end the year by underperform the STI by close to 10%. But when you look at longer terms, expect assets actually have outperformed the STI index. This is the 10 Singapore stocks that is currently in my holding, where I have 4 REITs, 2 industrial, which is CapitalLand Ascender REITs and Mapletree Logistic Trust, and I have a diversified risk focus on office and commercial building, which is Mapletree Pan Asia Commercial Trust, and I have healthcare REIT, which is Parkway Life. On the stock side, I have a real estate related company, which is CapitalLand Invest, and transport side, I have ComfortDelGro and also SETs. One is on the land and one is on the air and sea. On the financial side, I have OCBC and SGX. And industrial counter, I have ST Engineering. So this is the 10 stocks that I have, and their market cap is all minimum more than 2 billions, which are considered as a large cap company in Singapore. This is a price comparison of the 6 stocks against STI, where we see that only 2 counter have actually outperformed the STI, while the other 4 have underperformed STI for 2022, especially SETs, with dropped drastically due to the potential right issues coming. When compared to REITs, most of the REITs have underperformed STI due to the rising interest rate and high inflation concern. But long-term, all these 4 REITs actually have outperformed the STI, and I'm quite confident they are able to ride through this tough time due to their past track record and achieve a good performance in the longer term. So this is a snapshot of the current performance of the 10 Singapore stocks that I have, where currently I'm suffering a loss of 1,186, around 7 to 8% of my capital invested in these 10 stocks. I still have another 17,000 of cash, which is equivalent to about 37% of the portfolio, and I will slowly deploy this amount of money into the US and Singapore stocks along the way for 2023. And I'll continue to provide regular update on my stocks and unit trust portfolio in 2023. So do watch out for it. That's all I have to share with you today. And if you feel that this video has benefited you, do remember to like and share and leave your comment below to let me know what you think. And lastly, do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.